Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we are opening a file that, honestly, it feels less like a corporate strategy session and more like a triage unit in an ER.
It is good to be back. And you're not wrong about the triage analogy. This isn't just a quarterly review. This is a historic American company, and it is on the operating table.
We're talking about United Parcel Service, picker.ups. And the sources you brought today, they paint a pretty jarring picture for anyone who's watched this company. I mean, usually when we talk about logistics, the story is just more.
Always more. More trucks, more planes, more boxes, more volume.
But the thesis here is, well, it's the complete opposite.
It's the exact inverse of the last decade's narrative. UPS is executing what is probably the most significant network reconfiguration in its entire 118-year history. And the core of this, the thing we really have to wrap our heads around, is this idea of a strategic amputation.
A strategic amputation. So they're cutting off a limb to save the body.
Precisely. The thesis is that UPS got caught in what we'd call a low-margin trap. And to escape it, they aren't trying to grow their way out. They're deliberately shrinking. They're shedding massive amounts of volume.
Specifically, the Amazon packages.
Exactly. The Amazon packages, all to reset their cost structure.
Which really brings us to the central conflict of this whole deep dive, right?
Yeah.
Can you actually shrink your way to success? Is this some brilliant pivot to what management is calling nutritious growth? Or is this a company that's just shrinking into irrelevance, borrowing money to pay its dividend?
That is the multi-billion-dollar question. And to answer it, we have to dig into the numbers, because on the surface, they look absolutely terrifying.
Okay, let's start with a glide down. That's the term they're using for this, separation from Amazon. I read the Q3 2025 notes, and glide down feels like a bit of a euphemism. It looks more like a cliff dive.
It's definitely a steep drop. If you look at just the third quarter of 2025, Amazon volume moving through the UPS network, it didn't just dip. It dropped by 21.2%.
Let's just pause on that for a second. 21%. If a retailer lost 20% of their customers, they'd be boarding up the windows.
And it wasn't just Amazon. The total U.S. average daily volume, which is the ADV metric we use, it dropped 12.3%. Now, in logistics, density is everything.
Right. You want more packages per stop.
You want the driver dropping 5 packages on one porch, not driving 5 miles for one package. When your volume drops 12%, your density usually collapses, and your margins just get crushed.
But that's the weird part. This is the magic trick I'm seeing in the data. The revenue didn't collapse with it. Domestic revenue only fell, 2.6%? So how is that possible? Volume's down double digits, but revenue is basically flat.
This is where we have to talk about revenue quality versus just revenue quantity. UPS basically flexed its pricing power hard.
Why?
They saw the volume dropping, so they pushed the price up on what was left. Revenue per piece, or RPP, surged 9.8%, and that's the strongest growth in that metric in 3 years.
So in plain English, they just stopped delivering the cheap stuff and went all in on the premium stuff.
Exactly. Think of those Amazon packages as empty calories. They fill up the truck, sure, they keep the drivers busy, but the margins are razor thin. UPS basically said, we're full. We don't want your empty calories anymore. They're replacing those with high-yield packages from small and medium-sized businesses, SMBs.
But is that a sustainable trade? I mean, SMBs can be fickle. Do the numbers actually show this pivot is working, or is it just a nice story for an earnings call?
The data suggests it's real. SMBs now make up 32.8% of their total U.S. volume. That's a 340 basis point improvement, which in logistics terms is a massive shift in your customer mix.
And what about B2B?
Even more important, B2B business-to-business shipments have risen to over 45% of the mix.
And B2B is the holy grail, right?
It is. Delivering a pallet of machine parts to a factory loading dock is infinitely more profitable than walking up someone's driveway to deliver a single toothbrush. So yeah, they are trading calories for nutrition, but, and this is a very big but, you can't just rely on mom-and-pop shops to replace Amazon. You need a completely new engine for growth.
You need a new story. And that brings us to the lifeboat, I guess. The healthcare sector. I'm seeing a target here of $20 billion in revenue by 2026.
That is the bet. They grew their healthcare revenue to about $10.5 billion in 2024, and the goal is to nearly double that in just 2 years.
So why healthcare? I mean, is it just an aging population, or is there a structural reason UPS thinks they can win here? Because, Amazon's trying to get into pharmacy, too.
It all comes down to the moat, your defense against competition. Dropping a cardboard box with a T-shirt on a porch, that's a commodity.
Anyone with a van can do it.
Anyone with a van, an Uber driver, there's no moat. But healthcare, we're talking about things like temperature-controlled pharmaceuticals, live biological samples, complex vaccines that have to stay at exactly minus 70 degrees Celsius or they're worthless.
That's cold chain logistics.
Right. And the stakes create the barrier to entry. If you lose my t-shirt, I get a refund. If you lose a shipment of insulin or a cancer treatment,
People die.
people die. And the lawsuits are astronomical. That liability alone scares away the low-cost guys. It requires specialized buildings, specialized trucks, specialized tracking. Amazon isn't just going to spin up a compliant cold chain network overnight.
And looking at the notes, UPS isn't building this from scratch. They're buying their way in.
Aggressively. They have a pending acquisition of the Andlauer Healthcare Group, which should close around November 2025. That move alone solidifies their dominance in the North American cold chain. They also bought a company called Frigo Trans. They're positioning themselves to capture a huge slice of an $82 billion market.
Okay, so the strategy is ditch the cheap Amazon boxes, fill the trucks with high-margin medicine. But I want to push back a bit. Even with high-margin pills, if you cut 12% of your volume, you've still got empty space in those massive hubs. You've got drivers with less to do. You can't just shrink your revenue. You have to shrink the machine itself.
Which brings us to the actual amputation part of this. You're absolutely right. If you shrink your volume but keep the same number of warehouses, you go bankrupt. So they're executing this program they call Efficiency Reimagined.
Efficiency reimagined. You know, I always get a little nervous when I hear corporate speak like that. It usually just means layoffs.
Well, in this case, it means a deep structural cost reset. We aren't talking about just trimming the fat here. We're talking about removing bones. By late 2025, they had closed 93 buildings.
93, wow. That's not just shutting down a few depots. That's a massive reduction in their footprint.
It's the permanent removal of fixed costs. They're selling the buildings. And yes, regarding the human cost, headcount is down by about 34,000 positions.
That's the size of a small city.
It is. And a chunk of that includes a voluntary separation program for senior drivers. Now, this part is some interesting financial engineering. Management noted the buyout program for these drivers has a sub-1-year payback period.
Can you just break that down for the listener? What does a sub-1-year payback actually mean here?
Sure. A senior UPS driver is very well paid, top of the industry. So let's just say a driver costs the company $140,000 a year in total compensation. UPS offers them a $100,000 buyout to retire early.
Okay.
UPS pays that cash up front. But because volume is down, they either don't replace that driver or they replace them with automation or maybe a junior driver at a much lower rate. The savings they generate cover that $100,000 buyout payment in less than 12 months. After that first year, every dollar they save is pure profit.
It's ruthless efficiency. But if you cut 34,000 people and close 93 buildings, how do you even maintain service? I mean, doesn't this make the network really fragile?
Their answer to that is automation. By the fourth quarter of 2025, about 66% of their volume is moving through automated facilities. Robots don't call in sick, they don't need benefits, and maybe most importantly, they solve the peak season problem.
The Christmas rush.
Yeah, UPS used to hire this huge army of temporary workers every holiday season. It was expensive and chaotic. Automation smooths all of that out.
There's one other piece of this puzzle that I thought was really clever, but also kind of ironic. It's the deal with the U.S. Postal Service, the Ground Saver product.
This is fascinating. So think about the economics of delivery. The single most expensive part is the last mile.
Right, getting it to the front door.
Exactly. Driving that big brown truck 5 miles down a dirt road to a farmhouse to deliver one package is a money pit. It just destroys your margin.
But the mail carrier goes to that farmhouse every single day anyway.
Exactly. The USPS has a mandate to go to every address every day, so UPS realized, why are we competing on the money-losing part of the route? They struck a deal. UPS handles the middle mile, getting the package from the factory to the local hub. That's the profitable part. Then they just hand it off to the USPS for that last expensive mile.
So UPS keeps the steak and gives the post office the gristle.
Management calls it a win-win-win. UPS saves on the expensive delivery, the USPS gets more volume for carriers who are already on the road, and the customer gets their package. Eventually. But from a pure margin perspective, it is a brilliant move. It lets UPS serve rural America without bleeding cash.
Okay, so the domestic business, it looks like it has a plan. Dump Amazon, pivot to healthcare, automate everything, and use the post office for the tough stuff. But UPS is a global company. And when I look at the international segment in these reports, I am seeing a lot of red ink.
It's a huge headache. Historically, International was the golden goose. It had the highest margins in the entire company. But the geopolitical landscape has just shifted right out from under their feet.
We're talking about China, right?
We are the China-to-U.S. trade lane. For 20 years, that was the most profitable shipping lane in the world. In Q3 2025, volume on that lane plummeted 27.1%.
That's a collapse. Is that just a bad economy or is that the trade war?
It's a mix of everything. It's tariffs, it's nearshoring, companies moving factories to Mexico or Vietnam, and just a general cooling of trade. But because that specific volume is so high margin, it completely crushed their profitability. International margins fell from 21.6% down to 14.8%. That is massive margin compression.
And it wasn't just the volume dropping, there was a regulatory shock too, right? Something called de minimis. Can you explain what that is and why it matters?
Right. So de minimis is a customs rule. For years, there was this loophole that allowed packages valued under $800 to enter the U.S. duty-free with almost no paperwork. It's how companies like Shein or Temu just flooded the market with cheap stuff.
The fast fashion loophole.
Exactly that. Well, regulators pretty much closed that loophole, and suddenly every single one of those millions of cheap packages needs a formal customs entry. Overnight, UPS saw a tenfold surge in daily customs entries.
A tenfold surge? I mean, that sounds like a paperwork apocalypse. If you have to hire 10 times the people to process the same revenue, you're dead.
And that would have absolutely destroyed them. But this is where they deployed what they call agentic AI.
Okay, buzzword alert. Agentic AI. How is that different from, like, a chatbot?
A chatbot just talks to you. An agent does actual work for you. In this case, these AI agents can autonomously handle the entire brokerage process. So instead of a human staring at a screen typing, socks, cotton, value $4, the AI reads the data, classifies the goods code, files the entry with customs, and clears the package.
So the robots are doing the paperwork now.
They managed to handle this massive surge in complexity without their administrative costs exploding. It's actually one of the few real-world examples we've seen where AI saved a company from a regulatory crisis in real time.
So technology saved them from drowning in red tape. But technology couldn't save them from gravity. We have to talk about the Black Swan event, the MD-11 crisis.
Yeah, this is the kind of risk you just can't model for in a spreadsheet.
Take us back. November 2025.
A UPS MD-11 cargo plane crashes in Louisville. The initial cause cited was an engine detachment.
The engine just fell off the plane.
It detached during operation. It's horrifying. And obviously, the human tragedy is the primary story. But from a business risk perspective, the reaction was immediate and severe. UPS grounded the entire MD-11 fleet.
How much of their capacity is that?
It's about 9% of their total airline lift.
And this happened in November, right before the holiday peak.
The absolute worst possible time. Imagine you're trying to run a marathon and you suddenly lose 10% of your lung capacity at mile 20. It created this massive capacity hole right when they needed that lift for the high-value healthcare shipments we were talking about.
And I'm seeing a note here, an NTSB note about Boeing and McDonnell Douglas potentially knowing about part failures since 2011.
And that sets up a potential long-term litigation nightmare. If it turns out there was some known negligence with the airframe, this isn't just an operational blip. It becomes a liability battle that could drag on for years. But in the short term, it just forced UPS to scramble for other planes, lease capacity, all of which drives costs up right when they're trying to drive costs down.
So you have a company in the middle of this massive surgery amputating volume, cutting staff, and then they get hit with a fleet grounding. It just feels incredibly fragile. And that fragility brings us to the debate that probably has investors biting their nails. The dividend.
The dividend is absolutely the elephant in the room.
Right now, the yield is sitting at roughly 6.8%. That is huge. For a lot of people, UPS is basically a bond that delivers packages. But when you look at the cash flow, can they actually afford to pay it?
That is the core of the bear case. If you look at the cash flow numbers, they're pretty scary. In the first 9 months of 2025, UPS generated $2.7 billion in free cash flow.
Okay, $2.7 billion. That still sounds like a lot of money.
It is, until you realize that they paid out $4.0 billion in dividends during that same period.
Wait, hold on. Do that math again. They brought in $2.7 billion but paid out $4 billion.
Correct. They are, in effect, borrowing money or burning cash off the balance sheet to pay the shareholders. That is the literal definition of an uncovered dividend. You cannot do that forever. It's unsustainable.
That feels like paying your mortgage with a credit card because you don't want the neighbors to know you took a pay cut.
It's a bridge strategy. That's the bull case for management. They argue that their balance sheet is rock solid strong. They projected ending 2025 with about $5 billion in liquidity. So their argument is, look, we're in a transition, we're shrinking to grow, we'll use our savings to bridge this gap until 2026 when the margins come back.
So they are betting the entire farm that this strategic amputation heals very, very quickly.
Precisely. They have a target.
Yeah.
12% domestic operating margin by 2026. If they hit that, the cash flow catches up and the dividend is safe. But if the amputation gets infected, if costs don't come down fast enough, or that international business keeps bleeding, that dividend is in serious trouble. And if they cut the dividend, the stock probably crashes.
So what does this all mean for the listener? I mean, we've got this historic American company trying to reinvent itself in real time. This isn't just about packages anymore. It feels like a signal for the wider economy.
I think we are witnessing the end of the growth at all costs era. For a decade, tech and logistics were just about volume, user acquisition, top-line growth. UPS is kind of the canary in the coal mine for what you might call the extraction era. They are saying, we don't want to be bigger anymore. We want to be better.
Trading those empty calories for nutrition.
But the execution risk is just massive. This is a high-wire act. They have to stick the landing on the cost cuts. They have to integrate these healthcare acquisitions flawlessly. And they have to do it all while navigating a trade war and with 9% of their air fleet grounded.
It is a lot of moving parts.
It really is.
Yeah.
And frankly, the loss of that high-yield China lane, that's a permanent scar. I'm not sure they can actually hit that 12% domestic margin target by 2026 without it. It's going to be very, very tight.
Well, we won't have to wait long for the next big clue. The Q4 earnings call is coming up on January 27th, 2026.
That is the date to circle on your calendar. We need to see if those ground saver costs moderated. We need to see if the holiday peak was actually profitable despite the MD-11 grounding. That call is going to tell us if the patient is recovering or if they're still bleeding out.
Risk defined. Portfolio protected.
That's the motto.
We will be watching closely. Thanks for listening to this deep dive. It's a fascinating, if brutal, case study in corporate surgery. Let us know what you think. Is UPS a brilliant turnaround or a falling knife? Until next time.